Markets have been hitting all these new records, even though President Biden is expected to raise taxes at some point, begging the question, why aren't the markets more jittery about potential taxes? Joining us right now on that front is Jim Keenan. He is Chief Investment Officer and Global Co-Head of Credit at BlackRock. And Jim, it's a good question. Are the markets whistling past the graveyard here, or is there a real reason that they should continue to hit these new highs and not worry about what's to come later?
Yeah, I certainly believe that the tax policy will increase, and I think the market has gotten comfortable with that. That being said, the timing of that is important, and I don't think there are fiscal policies, even with this new administration, that is going to focus on tightening the market. So I think you're still seeing this even with the most recent increase in his plan to go to $1.9 trillion. They're looking to stimulate the market. Unemployment's still high. You're still moving through the pandemic and the rollout of the vaccines. So you're right that taxes are moving up, but I think the market is focused on this pro-cyclical tailwind that we have, really based on the amount of liquidity that was put back in the system, the combination of that, the vaccine. There's I would say, a significant tailwind from an earnings recovery stage. And when you think about relative assets, the equity market looks really attractive relative to other fixed income securities.
Yeah, I think part of it is we've just been having this conversation about Washington, and it does matter what Washington does. The market's figuring at this point you're going to see a much bigger stimulus package coming down the pike once again, right?
Yeah, and it's not just Washington, right? It's the Fed, it's other central banks around the world. You have this environment right now that I think from an earnings perspective, right, you have the consumers in a really good shape, right? You've seen this recovery in global asset prices, so net worth at the household level is strong. Income with regards to all the subsidies and stimulus has been strong. Savings rates have shot up into the high teens. So as you start to reopen the economy, and that will be lumpy and volatile based off of the rollout of the vaccine. But that being said, the gearing for recovery of equities or earnings is going to be pretty substantial this year as you start to see that pull through of reinvestment in inventory, reinvestment and the opening of the economy, and consumption can really kind of handle that. So I think, when you look at earnings risk premiums or where equities are being priced right now versus what you're seeing in cash rates at zero or the 10 years back to 110, the equity environment is still pretty attractive relative to earnings growth, not necessarily multiple expansion like we've seen in the last 6 months. But that's still, when you try to figure out how to invest in this regime, the equity outcome and supportive for credit assets, but credit spreads have tightened up dramatically and have limited runway at this point.
Yeah, we had Lee Cooperman on earlier this week, and he said he'd be very reluctant to get in anywhere in the credit market. Doesn't like bonds, obviously, municipal bond or treasury bonds, but also was not a huge fan of corporate credit either. Why are you constructive on that area?
Yeah, it's where in the corporate credit market you are. We do like the leveraged loan market. We like parts of the high yield market. There are other places to get income. Parts of the private credit market we really find as attractive to get yield. Some areas in EM where you can pick up some spread relative to the U.S. market, things like in Asia. That earnings backdrop that we just talked, like the supportive liquidity environment, the recovery that you see in earnings is very supportive for I would call it levered credit, right? And so where you're not taking your risk from interest rate sensitivity or duration, but really just earnings recovery. And so the framework is it's still supported by that earnings recovery and that liquidity backdrop, but you're just limited to what you can get because most of the leveraged loan market and the high yield market are now trading at their call prices. So there's less upside. So I think you'll still see a 4 to 5% return. And when you think about cash or other fixed income and rate assets, that's still an attractive excess return. Certainly not anywhere near the returns that you got a year ago, but still supported. And we like that front end.
Shepard Smith here. Thanks for watching CNBC on YouTube.